Today we are going to talk about the second word of the course concept. So it's the science of financial data, or financial data science. That would be the second. And so we talk about data today. And let's just recap a bit what we have done so far. So we started off the first few weeks to talk about intuition. Yeah? I called it like MBA intuition. So if you want, it's like the first block. So what did we talk about in the first few days?
Financial returns, a lot.
Which one? No.
The basics of finance.
Right, so can you give me a few of the buzzwords?
Shape ratio.
Okay, this is really the bigger ones. So let's say the Nobel Prize concepts.
CAPM.
The CAPM, yeah. So we had CAPM. So what is the CAPM used for? Maybe in the back row? What comes into your mind when you think about CAPM?
Explain market risk and asset risk or portfolio risk.
Yeah, to decompose
Yes.
the risk of an asset into market risk and idiosyncratic risk. Okay, that's good. What else? Maybe we start with the first concept. What was the first case about?
We have this mean variance point here.
That's the second one. Yeah. So we had second mean variance. This kind of also called Markowitz. So that's about choosing optimal portfolios. Yeah, assuming the expected returns are known and variance measures. And what was the first case? The Economist article in combination with equity risk premiums. It was about valuation. Yeah, so let's say valuation. Good. So we started off with valuation, and there we talked about the Gordon growth model, dividend discount model. Yeah, so kind of in a nutshell, what did that model say, or what was the intuition of that?
The intuition of Gordon growth is that the current value of money is higher than the value of money in the future.
But it's just time value of interest rate, time value of money. So that is independent of. It's reflected in that a little bit because we're doing discounting, but for Gordon growth, even discount model, people would associate more to that than just time value of money. Because time value of money just says I give you $1 today and tomorrow you give me $2. It's not about valuation. But if you say you're going to give me over the next 10 years, every year, 1 million, what am I willing to pay for today? Then time value of money comes in, because I have to discount all future dividends by a risk-free rate, time value, but also by a risk premium. Because I don't trust you, your payoff might be correlated with my market portfolio. Right? So Gordon growth model or dividend discount model is something that the price equals expected sum of future dividends. Yeah? So if I want, I can write a sum in. So future dividends, let's say the price in T, or I flag start at 0. So price in 0, expectation of 0, dt, all future dividends from 1 potentially to infinity, and I divide that by, let's say, 1 plus the discount rate. Now that in a nutshell is kind of valuation. We need expectations of dividends, and then we discount that by discount rate. The discount rate has a time value embedded, like the risk-free rate, but there might also be a risk premium embedded. And that is what I was after for the CAPM. Yeah, because the CAPM is a theory on how these discount rates are determined. So if I want to use my notation from here, so the discount rate in T according to the CAPM, who wants to give it a try, what would it look like? Annotation is slightly different in the lecture now, so just make it up on the whiteboard. So that's the way I tend to think in terms of notation. tell me about the discount rate of any type of project? So let's say this is the dividends of NVIDIA. So we want to get the discount rate of NVIDIA to determine the price of NVIDIA. So what does the KPM now tell me about the discount rate of NVIDIA? We are recapping things we have done. Maybe I phrase it slightly differently to help you learn further. Who wants to try? Can't be that difficult. So how many letters do we have? There's an RS, there's an alpha, there's a beta. So that's it. And if you're really geeky, there's an RN minus RS. So let's try.
It's alpha plus beta alpha.
Right, since it's the full discount rate, I would start with the risk-free rate. Yeah, the CAPM is in terms of excess returns, so I just bring RF to the other side. Yeah, because here, as you said, time value of money. So I would start with the risk-free rate plus the alpha. I leave the alpha away because according to the CAPM, there's no alpha. Okay, but we talked about it. So therefore, then I just have the beta times market, the discount rate of the market. Yeah. So so if that's the realized one, I take the realized market return. Yeah? So R of the market minus the risk-free rate. Good. Okay. So that's intuition part, what we have done so far. Yeah? Valuation, we connect dividends with their discount rate to get the price. We had Markowitz, which finds optimal portfolios, assuming these discount rates are known. Because if we know expected returns, we know the discount rate. That's the connection between these concepts. And with Markowitz, as it was said, we wanted to compute the efficient frontier. Yeah, so something here, you have different sigmas. Here you have expected returns, we call it mu. Think about the mu's, could be these discount rates here, coming from the CAPM. And then we are computing the mean variance frontier, find the portfolio with the highest tendency, with the highest Sharpe ratio, and then see the capital allocation line. Okay, and then the investors with risk aversion position themselves there. Okay. Intuition. Okay, so that's what we've done. And we then started to do one thing in the algorithmic section. Yeah? I think I called it differently, but right now I feel like calling it algorithm. So, an algorithm we talked about, let's say, is MLE within the tutorial, and then we had the Kalman filter. So, someone wants to try in his or her own words to talk about what does the Kalman filter capture? Why is it an algorithm? Why is it used? What is it used for?
That's what we introduced, the stochastic volatility model.
Okay, so we had the application here to...
Because we said that returns are not homoscedastic.
Yeah.
So our volatility itself is a volatility.
Yeah, so we were learning, the proper word is filtering, because the state variables are moving across time, so from a statistics point of view they don't call it learning, they call it filtering, but it's kind of the same. So we were learning, and as you are saying, the second moment of realized returns, yeah? Let's say of RT. So we have a time series, RT, T goes, and we have some training set, and we've been applying the Kalman filter to the stochastic volatility model. So we used the SVM. So we kind of had that RT minus the mean of RT is assumed to follow a Gaussian 0 because it's demeaned, and then we had sigma upper bar square e to the ht. Yeah, so we wanted random movements in the variance. One way to do that is this expression, so the ht is something we wanted to filter out. We talked about Kalman filter is to capture the first moment, not the second moment, so we did a transformation, take r squared, take the log of it, so the h came down into the drift, and then we could work with the Kalman filter. Now, you could also use the Kalman filter, for example, here. Yeah? If I give you realized returns So it could be another application which is a bit simpler. You have a time series of realized returns, and I want to know what's the expected return. So I could say that these realized returns are the expected returns as of the previous period, that we call mu t minus 1. And then we have some residuum, some forecast error, epsilon t. Then I have a time series for that. But this guy here is observed, and these guys here are both unobserved. But the sum is observed, because I observed the left-hand side. So we could also then use the Kalman filter based on realized returns, learn the expected returns, the expected return, which we then might want to use into the Markowitz optimization, because it requires us to know expected returns. So that's a connection, and how we can connect these concepts. Now let me ask you now, if that's my objective, and it's a good objective, it makes sense, how could I now try to learn the time series of mu t minus 1? So far this is just the measurement equation, so what is missing? A state equation, yeah? So you see I need to make an assumption. Because in order to use the tool, I need to provide the tool with a state equation. Good. And the state equation we could borrow from what we've done in the SVM. I could say simply mu t, so the expected return next period is the expected return this period plus innovation. Yeah, that's a different innovation than the epsilon here. That's right. So the nice thing is, parameter is 1. The epsilon mu here has 1 parameter. Sigma square mu. So I basically have to learn this parameter. I have to learn the variance in here. But otherwise, plain vanilla Kalman filter. So therefore, if you can apply the Kalman filter to a slightly more complicated problem, the SVM, you would also be able to apply it to a simpler problem here. Good. Good. So that's what we have done. And what I now want to do today is I want to open one box, and this is the data box. And of course, there's a lot of data, so I cannot talk about everything. So I need to focus and specialize, which I will do. And to make it very interesting, I will talk about tradable data. Now, what means tradable data? Well, tradable data is data that basically has a price. But it's not about I have to purchase data and that costs me, right? Everything costs something. No, but for example, I have a view on where interest rates go. Or I have a view on what inflation will be. And now I want to trade on that. That's what I mean with tradable data. And this is really interesting because what I think is most likely wrong, what every one of you thinks is most likely wrong. But if we have a price on it, it tells us that the market did clear because people had different opinions, but there was one price coming out. So it's like the wisdom of the crowd in that moment. So maybe one more thing you have seen in economics, which we might relate to today. If we have here the amount, so quantity, and here we have the price. Then we know there's a supply function, and there's something like a demand function. I assume they're linear. You could think about it, I've just linearized them. And this one here would be the market price. Yeah? Let's say this is the P star. So that's the price where demand and supply equals. Yeah? Therefore, when I say we talk about data, which is tradable, we talk about data being some type of quantity that people want to buy, others want to sell. And there will be a price. And we will focus basically on these prices, be it the price of an interest rate, or be it the price of a stock, and so on and so forth. Yeah, that's a bit what we are talking about today. Good. Good. Now, I've decided to focus on two things today. First, it's a bird's eye view, so I cannot go into detail in everything I say. But I just want to give you basically a start to shape your thinking. And the other one is, I don't want to give you the view of an academic, but I want to give you the view of a trader. Yeah? Because it's about tradable data, so therefore we should talk to a trader. And the traders are very busy, so therefore I just wrote down what they would tell us. But that just reminds me to the symposium tomorrow. So if you want to have more practical insights, then tomorrow we have a few active investors who come to the symposium to talk about how they use AI in their risk and asset management. Okay, but here, that's what we do. So we will first talk about data. Why is financial data different than data in other science disciplines? Second, what does a trader know about data? And then we also talk a bit about arbitrage, spot versus the futures market. And we talk a little bit about a platform we have access to where we basically can monitor all traded products that Deutsche Börse is offering in the spot, in the futures, derivatives market. So by then we kind of have a feeling what these markets all mean. Good. These will be the milestones for today to understand why finance data is different, get what a trader knows about the data, and then see a bit on high resolution data we got access to. So let's just start machine learning, why finance is different. Now that is taken from a, let's call it policy paper of AQR. It's this hedge fund I've referred to. There are many famous professors, active professors working there, and it's a fund that came out of finance PhDs from University of Chicago. It's pretty famous. They do very good research. Whether they beat the market, I don't know. Most likely not. Yeah, but you can do the research. And they have a paper which I thought is interesting for you because it's maybe 4 pages. It's written for people to who want to invest their money on, so it's not too technical, but it's not technical at all. And they are summarizing their view on why finance data is different when it comes to apply machine learning to finance data. So the first reason is low signal to noise ratio. So machine learning tools have been developed in computer science departments on problems with a high signal to noise. Like picture recognition, handwriting recognition. And if you look at asset price data, especially stock returns, they are driven by epsilon. So epsilon, see, I even didn't write in the epsilon here because the cap M is about expected returns, okay? I have my epsilons here. I think I write the epsilon here as well. Because I have the expectation operator here, so it would be fine. Yeah, so it would be cool. So it kind of highlights the discount rate itself can deviate from what I say the cap M, so epsilon should be 0 within the cap M. But I think as the student said, we have idiosyncratic risk, systematic risk, so even within the cap M. So I would say these are the idiosyncratic movements in my discount rate. These are the market moves. And if I do valuation, the price is expected dividends over the discount rate, but you see this expectation here would take care of the epsilon, which is mean 0. Yeah. But I just want to add it in to connect to this paper here, to this argument that stock prices are mostly driven by these epsilon innovations. And that corresponds to unanticipated news. So things I could not forecast ex ante. Which results in the fact that asset price data, here again, it's equity that they focus on, is low signal to noise. And low signal to noise, you know from our Kalman filter application from last week and your upcoming problem set, is just saying us that there's little information in the observation with regard to the unobserved state. Yeah? It's like if I want to learn this mu here, expected return, this epsilon is the enemy as I've named it, that's the noise. This guy has a high variance, and therefore it will be difficult to learn the mu from observing the R, because a lot of the R movements is with regard to epsilon, and epsilon has no information about the mu. That's kind of what I talk about here. In addition, there's an economic force, so it's not about noise in the data itself, it's about that investors in the market, they want to maximize their profits, and you have competition among investors. So therefore, if you have a predictive signal, so if you know someone comes up and says, I found, and I've tested everything rigorously, if that signal goes up by 1%, which by the way it just did, market goes up tomorrow by another percent. Now, what you would do is you would now trade on that if you believe in that. But if a lot of capital trades on that, then that information gets reflected right away. So the price would jump right away and not tomorrow. Yeah. So this is this thing about the economic force of profit maximization, which makes what seems to be a strong signal be priced into the market, and therefore the predictive relationship doesn't exist anymore. Okay. Now the second, it's related, it's the idea of these evolving markets, and I think that's what I just talked about. So if you identify this mispricing, if there's sufficient amount of capital going into that mispricing idea, then the mispricing will disappear. So I took a quote from the paper, yeah, which says, if you do picture recognition and you have a good algorithm in identifying cats, then the picture of a cat is not morphing into the picture of a dog just because your R-square approaches 100% in identifying the cats. But that's something that happens in finance, with my example which I just had. If you have this predictive information, so you know about mispricing, as they say, and I will say something else to it, then it should disappear if many people trade on it. Or it's just enough if one person trades on it, but with a lot of money. Now, you see now, they talk about mispricing, and we haven't talked about mispricing too much in the intuition part, a little bit, so let's put another dot here. I've mentioned, and now I will do again, the cap M is about an equilibrium return, equilibrium premium. And I've mentioned, and I mention it again, if something is in equilibrium, it says it will not disappear just because we are aware of it. Right? Because if there is systematic risk, if the investors are risk averse, then there will be a market risk premium, even if we talk about it. But mispricing is different. If we start to talk about mispricing and we give evidence that this is a mispricing and you have a forecast why it should disappear within a specific amount of time, as we talk, as knowledge comes, this should disappear because people start to trade on it. So let's have a refresher. Within the cap M, what was the relationship between the expected market return and, yeah, I maybe leave my questions open and I just say, how is in the cap M the market expected risk premium determined? It's something that usually gets overlooked. It's the risk aversion of the market, so it's the average investor, or it's the risk aversion across all investors, the average, times the variance of the market return. Yeah? So if that's the argument I just did 2 minutes ago. I said if the investors are risk averse, then there will be a risk premium, whether we talk about it or not. It's an equilibrium, it's there. But if it's a mispricing was the alpha, which I even didn't put in here. But we had the security market line, no, we didn't have it. Yeah. So again, it's a nice repetition here. We have beta here. Here we have a security market line. So here we have the risk-free rate. Let's say beta 1 is the market. So then this would be the expected return of the market. Right, yeah. If something has a positive alpha, this would be positive alpha. The discount rate is too high, If the discount rate is too high, the price is too low. Right? It's an undervalued asset, you should buy it, it's mispriced. So you see, mispricing refers to something, like a theory or something, in which you see the CAPM, security market line. Yeah, we're saying if there's an alpha positive, stock is mispriced, meaning its discount rate is higher than it should be according to the CAPM, which is a theory, an equilibrium theory. So you should buy that high alpha stock. If you buy the high alpha stock with a lot of capital, you are increasing. Oh no. No, wait a minute. Why is no one saying something? It's not an econ class, okay? I think this looks more intuitive, does it? As the demand increases, the price goes up. If someone sells one coffee, it's maybe worth $10 because it's the only coffee, but if he has 1,000 coffees, then price per coffee has to drop. So what you see is if now demand goes up because people want that positive alpha stock, all else equal, the price will rise. Right? And if the price rises, we go back to our valuation intuition. Dividends are not changed. It's a business model by this mispricing thing. I'm buying it because of the alpha. So what we see is the price goes up because the embedded discount rate will drop, right? And it drops exactly to the point where it coincides with the theory implied one, CAPM, assuming the CAPM holds. So, okay. So I try to make connections back to previous classes, yeah, to help you get strong in these concepts. Okay, now the third reason why finance data is different is they talk specifically again about equity price data. Is they say that it's a small data set. They say asset pricing is a small data set discipline. But there one has to be a bit more careful because asset price, what's an asset? It's exactly what we do today, traded assets, traded data. So there's more data than just equity. So therefore it is true if you look at a research paper for stock predictions, which maybe makes up at least 80% of the literature, closer to 90, then that is a small data environment. They usually work with monthly data. Some do daily, but most do monthly. And you don't have many months, right? 12 per year, and data going back. I mean, you don't want to start in 1400, even if you had the data. So usually they would start maybe after the Second World War, 1950, 1960, somewhere in this period. I showed you once for the Economist, but doesn't matter. Okay, but just to connect back, maybe it matters. In the Economist, you've seen there was a nice chart about returns in specific periods, like Second World War in Germany. It was a very bad return performance. So you see also it will affect your learning model, right, if you use that type of data. So therefore, when you start in the 50s, it's usually with US data. So they had like very good regimes after the Second World War. So what we do in our research is we aim to go with big data sets. So how can you go with big data if it's a small data environment? Well, you have to shift. And the way you shift is either you change the frequency, so you can go to high frequency. Now in the intuition part, we've talked about predictability in higher frequencies. And we've seen it was in the Economist had a 15-year prediction horizon. I showed you regressions, 10-year horizons, and I showed you the same regressions for a 1-year horizon. And you could see the R square in sample goes towards 0 if you shrink the forecast horizon. Yeah? So therefore just going high frequency is nothing an asset manager would do necessarily, because the signal to noise ratio gets even worse if you go to higher frequencies. Two things to be said. If you go to ultra high frequency, the picture changes again. There's a very interesting research paper from Princeton, maybe 2 years old by now, and they looked at order book data, which we have at the end of today's class a little bit, and they found out of sample R squares of 15%. which is a lot relative to if you go monthly equity and you have 1%. And I'm already optimistic, yeah, saying 1%. I think it's 0.8%, the strongest they had, having these neural networks. While in this ultra high frequency, they show it doesn't matter which method you use. The predictability is roughly between 12 and 15. But interestingly, it disappears, the predictability. Within 5 milliseconds, half of it disappears. And, so just tells us for firms, algorithms were really fast and really smart. Not that smart in a sense, because you need to be very fast. And smart usually takes computation time. So you'll say if you can handle this ultra high frequency data, there's a lot of predictability in there. And the other thing to change is look at different assets. So if I know that the NVIDIA stock return, why do I say NVIDIA today? Let's say the BMW stock return is difficult to predict. Then maybe I use other data that helps me to make better predictions. And one thing that I could use is, and that's something we will talk about later in the course, and we start a bit today, but very, very gentle. So it really starts in maybe next week. There's a holiday the week after. I could use option data if I understand there's a relationship between the information priced into options and the information priced into stocks. So therefore you kind of see we want this extra data section today to get more fluent in what is information inside data and how to use that. Okay, so but I think the point is valid under point 3. If you work with equity return data, you're trying to predict that, you don't have sufficient data to really run big models. So therefore, that will not work. I mean, it might work, but the results you get, we talked about that, being not significant and the like, so you're just fooled by randomness. The last point is also important for finance, but it gets more and more important in all science disciplines. In finance, the point is more that you have regulation, which requires the asset manager to communicate and understand the risks in the client's portfolios. So therefore, there's the inherent need of working with white box models. Yeah? At least make it interpretable. But interpretable AI is a big topic also in research. So what they conclude, and I completely agree, and later in the class I show you a few research papers who support that claim, is that what you want with such type of data is you want a structural approach. So what is a structural approach? Not structure, so there's some structure. But where's the structure coming in? It comes before you look at the data, basically. Yeah? So the structure is something that I have in the intuition part. I know in reality prices are determined by supply and demand. But it's just difficult mathematically to get a grasp on what that really tells me. Now, I use that for intuition, but that's the way I use for thinking. That the price in my structural thinking is dividends over discount rate. Boom. Or I use the structure that the discount rate of a firm should be linearly related to the discount rate of the market. And it's also another structure. And if we work with such structures and in addition make efficient use of the data, then research has shown that that is going to produce stronger predictability. So therefore kind of the structure we put in by using that equilibrium / intuition thinking is like a regularization. You might have seen that already. If you have a big model with many parameters, you cannot identify them, you regularize. So you're penalizing for parameters just to be there. And you can think about the structures that we put on like a frame, it's also regularizing. Yeah. For example, let's assume in reality really something like the CAPM holds. And if suddenly I work with a model and it's going to find out, or it's trying to search in an area where the discount rate strongly deviates from that. If I put on that structure, it's like prior information, right? I would basically penalize and say the algorithm, don't waste your time looking there in a low signal to noise environment. So you will most likely get lost anyways and come back with something which is not really predictive information. Rather focus on something else. And this helps me to tell the algorithm where to look for if I build a model using that type of information. That is going to come in the far future of this course. For now, just these 4 arguments why finance data is different. Usually small data sets, we need to interpret things, we have low signal to noise, and the markets evolve. Markets learn, get smarter, they price it in. Pattern is gone. Right. Good. Now let's talk about our second topic of today, a trader's view on financial data. Now that data, I've been thankfully taken it from a Eurex trading certificate class, which I took. It was the last that got offered, so I don't think I do any harm by sharing some of their material. So therefore, you could take a certificate in the past for becoming sophisticated in trading products on the levels of futures, swaps, and options, right? And now I just give you a summary of what that material captured. I think it's pretty useful. So it's the first time I teach that, but it's also the first time we have a financial data science course, science of financial data. So I really want to, now that you have this intuition and already a glimpse on one algorithm, talk about the data. So to spark your curiosity also. Then go out, GPT, whatever you want, and try to deepen your understanding, or write emails to me, and so on and so forth. This is a high-level overview. Okay, so first, why derivatives? So I just followed the structure from this trading course. Now, we haven't yet talked about derivatives. So what will be kind of said is the following. P is the price of a stock. We call it an underlying in the future, moving forward. And that's something that really trades on, a lot of stuff I'm saying comes up on the slides, but I just try to connect already, so you hear 2 times. Now, I don't know, Börse vor 8, I think is the name of it. Yeah, sometimes you see this great floor where someone sits on a screen, or you see these older pictures where traders are shouting at each other and giving each other signs, like I want to buy 2 things, like a 2 beer, but first the stock and then the like. But that's usually what they're trading are stocks, or yeah, let's just say stocks. So you can think about the stocks being, it pays dividends in the future, and you divide by it a discount rate. Now derivatives is now an instrument on that stock, for example. That's why the name derivative. You derive its value from something else which is traded. That's why tradability is important. So therefore, and for derivatives you have an extra exchange. So for Deutsche Börse it's called Eurex. There you trade futures and options, 2 types of derivatives. In the USA, for example, you have the Chicago Board of Exchange, CBOE, and there you trade options. While the stocks you buy in New York, usually at the NYSE, so New York Stock Exchange. Yeah? So therefore derivatives are on a different exchange, but their price depends on the price on another exchange where the stocks are traded. Okay, so therefore the question comes up, why derivatives at all? Okay, so point 1 was already said, the derivative derives the value, also means the price, from an underlying and contract characteristics. Yeah, kind of I could have a derivative, either a futures or an option on the BMW stock. But I need to know what are the characteristics. For how long does the contract live? The stock lives forever, ideally. But a derivative usually always has a fixed maturity date. Boom, then it's over. And it has other contract specifications, some we will see. Okay. Now the underlyings are equity, which is here. Bond, it's also here. What makes a bond a bond? That's called a coupon bond. So the D is called a C, and C stands for coupon. Yeah, so if you buy a 5% bond of the German government, it says you get a 5% coupon every year. Now you have to discount that, okay? Time value of money, but also a risk premium. Not for market risk necessarily, because it's not equity risk, but There could be inflation risk, right? If now the government starts to print a lot of money via the central bank, the currency depreciates, and the dollar you get or the euro is worth nothing. So therefore, there will be a risk premium to that as well. So the valuation is exactly the same logic. Commodities could also be in underlying. We had that in one case, yeah, where we had commodities and REITs, and we asked how does the minimum variance frontier change if we do that. And so if you go to, let's say, Eurex, like Europe's largest exchange for derivatives, you can buy futures and options on a few commodities. Not every commodity you might be interested in, but a few. Okay. So in general, you can think about mathematically that a derivative could be rewritten, or you could construct a derivative such that it mimics the value of the underlying. Okay, but the goal is not to do that. The goal is basically to have a more general asset whose value is derived from the underlying, and which doesn't mimic the underlying, but it's derived from it. But the last point is still fine. Good. So that, you see, since I just copied, some of the stuff is German. I hope you don't mind. My stuff is then English. So I like that thing. I will write that also onto the whiteboard. So how to think about a stock. And we will use that later to move on. Coming back to this decomposition kind of. Yeah, so it's not a composition from a research paper or the like, but I kind of like it. And I think you will also like it. Good. So we have a stock. A stock itself is a piece of paper, right? That's the way, I mean, nowadays you don't get sent a paper. Hi, congratulations for buying BMW stock. Yeah, but in the past you had a piece of paper under your pillow, and if someone robbed you, then, I mean, go back to 1850, now that guy had the stock and was the owner. So if you have a stock, you basically have a piece of paper which says you can claim ownership for part of a firm. Huh? So, and here's this decomposition, yeah, where we kind of think about the value of a stock. More proper, the value of an underlying. But okay, let's say underlying. The value of the underlying. Yeah, for example, stock. You can think conceptually, it has different components. It's the value of. Yeah? Try a bit of computer science notation here. Value of, and now I make geschwungene Klammer. And what's the value of? It's the value of the capital. Yeah? So let's say capital. So that's interesting. Kind of, let's say the firm, there's a company, it's worth 10 units. Doesn't matter what the units are. Yeah? Let's just normalize it. 10. And I now put 1 unit cash towards the firm. And for that I get 1/10 contribution of the firm. So that's my capital. The firm costs 1 billion. Alright, I make such big numbers. The firm costs 100 million. I give 10 million capital from my Girokonto to the firm, and now the firm gives me back ownership to the firm. So now 10% of the firm belongs to me. I just exchanged capital basically, right? From my Tageskonto, let's say, I move that to someone else, the firm, but the firm gives me back something in return, which is the stock, contribution, share of the firm. So that's the capital. Now the second thing which makes up the value of a stock is the value of Einkommen. Yeah? So in our notation, it's dividends. Exactly what we use for valuation. So if I give these 10 million to a firm, I could do it just to save my capital, yeah? Because maybe I'm scared I get robbed, or maybe I'm scared that the currency I hold the money in will devalue and the firm is safe. That really happened during the 2008 financial crisis. Big institutions were thinking where to park the money. So capital is just parking. But now it's about dividends. Yeah? Usually we are buying something because we want dividends. at least I need to purchase a coffee in the morning and some lunch over lunch. So I need a bit of cash. And getting dividends is a form of getting cash. Cool. So therefore dividends. The value of future dividends will also be making up. And you kind of see it. The dividend discount model is ignoring this capital thing. It just says the value of a firm are discounted value of future dividends. That's the connection of that thinking. But in general, the value of the stock is the capital, the dividends, then Stimmrechte, so it's voting rights. So if you have a voting right, this has value. What's voting right? If you own 10% of a firm, you can come at least once a year and say, I'm not happy with the performance of the CEO. I want him to be kicked out. Who are you? Doesn't matter, I have 10% of the firm. Right? That's the voting right. And that has value. So you also see already, coming towards the derivatives later on, I'm just working here with words a bit. If you have a right, that must have value. And derivatives will be about right. Okay, next thing we have is risk. So they call it risk here, and what I have in mind is price risk. So keep in mind, value is price, so it's price risk. Okay, now what is price risk? It is that the value of the firm, let's say I put up these 10 million to buy the firm, 10% of the firm is worth 100 million. Okay. Now, next day, the bomb drops and the firm's only worth half. That's a problem, because I have 10% of it, so my 10% is also worth half. This is price risk. This is risk. Yeah. But on the other hand, maybe they have a great patent or something, the price is worth a double. Then my 10% is also worth a double. This would also be classified as risk. So risk, therefore think about risk in a statistical sense. You can think about risk, already when we talked about the Kalman filter today, it was said risk is like variance, the second moment. Yeah, so that's really something to think about risk here. So risk in this setting, so maybe let's say risk for this value, or let's say price, would be really something like the realized price in the future, T, so this is larger than small t, but I'm not sure I need to be that accurate as of now. So that's just P in the future minus what I thought the price will be. Okay, now that gets squared, and I take the expectation of that. Yeah, so the typical formula of the variance is something you can think about risk. We've done that in Markowitz. Markowitz risk is variance, exactly the same thinking. I think here for today, keep in mind, when we talk about kind of futures, it's about eliminating the risk of these price movements. When we talk about options, it will be about that the price is a transform of the return, right? That's kind of clear. Price return related by the log. So what we've done in the SVM, we have computed out the second moment, the volatility. Where are you? Here. So when we will talk about options, it will be about trading variations in the volatility. While when you trade the futures, it will be about trading variations in the price itself. These are two different types of risk, right? That's the second moment risk, and maybe you can call it first moment risk if you want. Yeah, because the price, first moment would be like the expected price. But here it's about futures. I want to protect from adverse movements in the stock which I bought, while for the option, if I bought the stock, I also bought in a specific volatility, and that volatility will also change, and I want to either benefit or hedge variations in that. And for that I would use an option. So you see, options futures are slightly different, but they also have some similarities. The values derived from the underlying, the P. And the underlying, conceptually, you can think about, has these types here. There's the capital, there's dividends, voting rights, and there's risk. Good. If you have a question, just interrupt me, okay? Okay, now let's talk about then derivatives. There are two types of derivatives. One are like the futures, so in German it's called Termingeschäft, or sometimes we hear forward contracts. We will see later the forward is exactly like the futures, just traded off the counter, not on the exchange. And then we have options. So when you think in terms of this picture here, Termingeschäft, they talk about price risk, Preisrisiko. That's what I also said. It's about the price. So the risk in the stock might be something that the stock investor is not comfortable with. So the stock investor could buy a futures to offset that type of risk. Right? For example, I hold Nvidia because I'm so bullish on it. I have $1 billion invested in it. But I'm not really sure over the next 2 weeks it will look good for Nvidia. Yeah, maybe they report earnings and I have some information that might not be good. I don't want to sell my 1 billion exposure of stocks, but I could offset that by buying some futures, but I must short the futures. So I must take a negative position in these futures to, if I get the right amount of that, I can eliminate that risk for a specific amount of time. Because my futures has a maturity. Yeah? So if I'm scared of the next 2 weeks, I buy a 2 weeks futures. If I'm scared until infinity, I'm a Markowitz investor with high risk aversion, it means I don't go into the market at all. That's the difference here. Yeah? So do you see futures, the reason it has short maturities is because there's something in the short horizon I want to hedge. Or I have information and I just want to speculate on it. Good. So futures are these Termingeschäfte. Good. Usually you have like futures and swaps. Yeah? I don't go into more detail here. It's a bird's eye view. There's a derivatives class. You have more futures on that. Or if you just get interested in that, I think you find your way. These are all standard terms. So the risk that you have if you are considering the stock, and you go back to the variance equation here, is you see the variance has kind of two parts to it, right? It's the deviation to the positive from the mean and deviation to the below the mean. Both come in here quadratically. So this is what it says on the slides, yeah? That you have two types of risks. One is that the future value might be above the mean, which is your expectation of where the price will be in the future, and the other risk is it might be below. So of course, if you're long the stock, the real risk for you is that the price in the future is below what you anticipate. Yeah, but maybe you're short the stock, then it's the other way around. And good. What you can do with the futures / swap is you can cut out the risk of the underlying, and that risk now becomes tradable. Now, that's a typical thing in finance, in development of financial products. Someone starts off with one asset, and then the guy's like, okay, I would like the asset much more if I would get rid of the risk here. And then the investment banks start to think about, okay, can we somewhat package the risk out and sell it to someone else who might not be interested in all of the rest, but just wants to get compensation for the risk. And then you have a futures born. Historically, I'm not prepared for that, but now that I talk about it, I think it kind of got developed in German, die Baumwollernte in den USA. Yeah? So, because you had a farmer, and the farmer is going to harvest the cotton, but only in the near future, but he or she has to pay already for the employees, for the machines, so they need money. So what they would be interested in is to reduce the value of their cotton by eliminating risk. But they would be fine with that, yeah? Because they say risk is deviation from the mean anyways. I'm just going here for the mean because I produce cotton to get an expected price in the future. And then there is another financial trader, arbitrageur, speculant, whatever, and he's like, I have some excess cash, I want to get alpha, so maybe I get alpha by just purchasing these risks. They have a value to it, maybe the value tomorrow is even higher. That's how I speculate things. Why is the maybe higher next period? Because he has a machine learning algorithm back in 1800 which told them the weather forecast will be much better in a week from now than it's now, and harvest will not be negatively affected by it, blah blah blah. So you just see these are different opinions, but if we see prices move, again think about demand supply, then prices move because demand and supply has moved, and they themselves are functions of expectations and opinions. Good. We say futures are symmetric derivatives. And the valuation of a futures is done by no arbitrage. So basically options and futures are both valued by no arbitrage. What means that no arbitrage? The point is that this is a fundamental valuation we're doing here. Yeah? We're saying the price depends on expected dividends over the discount rate. But if I now have a derivative whose price depends on the future value of P, then I could still work with this fundamental approach. I then just have a second expectation here, which is a bit cumbersome, but I can do that. But the way it's done in practice is what it says here, valuation easy. Yeah? I basically go back to what's the value of a stock. The value of a stock has these components, and then I isolate the value of risk. So I say the price of risk here will be the price of the stock on the left hand side minus the capital minus dividends minus the value of voting rights, on a conceptual level. So that's why I kind of like this previous slide, because it provides this intuitive view that if you want to value that futures, you really see how the value is derived from the stock and how you subtract off things that you don't own once you buy the futures. So let me give you one example that I like to think about. Now let's say I have a stock and I want that stock in a month from now, but I don't want it now. But I want now to be sure I will have it in a month from now. Yeah? Because maybe in a month from now it's not there. Or maybe the price is too expensive. So I want to know today what's the price I'm paying for the stuff in a month from now, and I want to be sure I get it. So I can buy a futures, which has a maturity of 1 month. And in a month from now, the futures will then give me back that certificate, now you own the stock. Okay. And I have to pay what I've agreed upon today. Good. Now what happens if there's a dividend paid out in 2 weeks? The stock pays out a dividend to the shareholder. So who gets the dividend? Me or the person who still owns the stock? The person who owns the stock has the right to all the dividends. Yeah? So the dividend goes to the stockholder. So although I have the futures, I don't have any rights on the dividends within maturity of the futures. Only after a month, when I get the owner, because my futures says now you are expired, now you have the obligation to take the stock and pay what you said you pay. Now I'm the owner, so I will get all future dividends. Yeah, so the nice what I like in this example is it highlights to me that if I have these futures now, I don't have a right on the dividends which are paid out while during the life of the futures. Yeah? I only get dividends after the life of the futures when I'm the stockholder. And you see that in this valuation here, that you take therefore the stock price of underlying, think about intuition part, it's the value of all future dividends. I said in 2 weeks, that's the future. And from that I have to subtract the price, the value of dividends. Yeah, so if the dividend over the next 2 weeks is worth, let's say 10% of all ever paid out dividends, then I should deduct roughly 10% of the stock price. So the futures and the stock price would then have a difference of roughly 10%. Just roughly, because I have the discount rate, but if I discount just by 2 weeks, the impact is basically close to 1. Yeah? Because the discount rate over a 2-week horizon is still pretty small. Okay, and you see that if you go to any news channel, you see the futures price on the S&P 500 and you see the stock, the index value of the S&P, and they are slightly different. And that's the reason for that. Because this futures has some maturity. Within that maturity, the dividend is deducted from the futures. Voting rights, that's more difficult. Because you also see in Gordon growth, we are not considering voting rights. But we just know intuitively it has a value, but it's difficult to use that for real quantification. Okay, what's the time here? I think I need to speed up a bit, but let's not do it now. What about options? Now options, that's what the chart kind of tries to say. With options, I could decide whether I just want the upside risk or whether I just want the downside risk. For futures, I have to take both. Again, my example, I go long the futures today, it matures in a month, so in a month from now I get the stock BMW for a price I agree, demand supply today. If the stock drops to 0 in a month from now, bad luck. Yeah, I'm bad luck. It's my stock then, it's worth nothing. Okay, bad luck. If it goes up by factor 10, good luck. No? That's why it's symmetric. It's a linear function of the value of the stock. Now for options, I can slice, I can just say, I just want the downside risk or the upside risk. And what's the value to that? So, if I want this upside potential, I would buy a call option. That's called call. If I want to protect from down moves in the stock price, I can buy a put option. So the put option would pay off well if the stock price is below what it is today, let's say simplistically. And now comes the point. So it's not about where the price is today, but it's about what we call strike. Strike is part of the contract. So strike is, what is my comparison here? Yeah, I said price today simplistically, but in reality it can differ from the price today. It's called a strike. I still like to think about this one here. So I wanted to work with this variance formula here. Now think about what the variance captures. The variance captures, yeah, maybe I write that here. If I keep working on that, yeah, I have risk, so I assume it's variance. Now, what is that risk? That's why I said it's the risk in terms of the price, not in terms of returns. Yeah, I'm not doing statistical methods here, so I can work with a non-stationary variable, but I just try to highlight what it is. So what is that? Expectation of. Okay. So what's the expectation? Let's start simple. I have an integral from minus infinity to plus infinity. Everything can happen. And then I take the price in the future. Usually, how do I call it? Okay, I think I don't do it. I apologize. It takes me too much time, and I think the benefit is too limited. I think I just do it intuitively in the sense that, what I said previously, that risk in terms of variance captures both parts, the left tail risk and the right tail risk. And with the option, I can just focus on one. And the focus point is kind of the strike. So I could say my focus point is today's price of the underlying. If I'm above or below, this is what I consider risk. Or I can just say it's the price today minus 10%. So the strike would be today minus 10%. So the strike is also a dollar value, which is part of the contract. And we will see next week, the strike is an important consideration in constructing predictive signals out of options. So therefore we come back to that. So for now I don't go too much into detail there. A point which is important, if you price the option, you cannot simply use what we've done with the futures. but for options, the valuation is always model implied. Let's connect back. What means here model implied? At the end of the day, all prices on the exchange, and also that you guys agree upon with each other, if it's done fairly, yeah, without a gun in the back, it's done by demand and supply. Yeah? But why do I say model implied pricing? Because already that is a model here, right? I need a model for the discount rate, I need a model for expected dividends. So you kind of see intuitively, we need models to determine prices. But supply demand might have different models in their mind, or they have even the same model, but they model things differently. So therefore they disagree, and so you have trading happening. Good. And if you think about these option models, what they do is they need to carefully model this upside and the downside potential in the stock price. And we have done already something in our course so far, because we talked about the stochastic volatility model. So that was already, let's say it's the simplest of what I call here these affine jump diffusion models. Because it assumes that the return deviation from the mean is driven by a Gauss variable whose second moment moves across time. So that's a diffusion. I have time varying volatility. So now I could price an option. Assuming the model is correct, I could price what's the value of an option on that stock price. The volatility which I capture through that parametric model is not perfect. So if I later check on the realized volatilities, they will differ. So that's my model implied pricing errors, which I do. In order to minimize these pricing errors, I can make the model here more interesting, let it capture the data more properly. I could, for example, say, let's allow for HT to also jump, which means make a 10 standard deviation move to up or down at no cost. This is a jump. Or I could say I'm adding here another shock which captures a jump in the return itself. Yeah, this is what affine jump diffusion models do. So there are a generalization of the stochastic vol model. They are used to model where's the price in the future, and they have a specific accuracy in terms of the volatility which is embedded in the price. Because the option gives you just upside or downside potential. So you will, the value depends strongly on the volatility that gets, or that is expected to occur until maturity of the option. Therefore, if you trade options, you are trading volatility. If you trade futures, you are trading stock minus the present value of dividends, simplistically speaking. That is the difference. Yeah? You see that volatility is implicit in here, but options make it explicit. Now, if you go to a derivatives class, and I think even in my class here, I have a section first time in option pricing. So Black-Scholes, we will at least spend 20 minutes on it. If you want to spend more weeks, then the derivatives class would be your choice. Which means we will have a class, but it's maybe in 4, 5, 6 weeks, where we go through the mechanics of how the option is really actually priced. Today it's just a bird's eye view on tradable data. Okay, so here now how to value a derivative. So here's the roadmap. So the valuation, it always starts with the spot market. In German it's also called Kassamarkt. So it might be Xetra in Germany at Deutsche Börse, also called Pakethandel, yeah, maybe you've heard these terms. Or you have the nice New York Stock Exchange, you have the NASDAQ, which is more the technology stocks in the US. So that's the spot market, Kassamarkt. That's the P. That's the dividend growth model, right? This is where everything starts now for derivatives. So that price of the underlying is observed, which means this entire dividend discount model stuff, it doesn't matter anymore if we want to do derivative pricing to a first order approximation, because we observe the price. There's also here called the basis. Okay, and what we then want to compute is what's the value of the futures or the swaps or a forward contract, which all have a similar mechanic in the background, which is you're pricing such a forward on such an underlying by taking the value of the underlying, and then you cut out these components I had on the boards, which are not part of your futures contract anymore. Good. The most prominent one are dividends that are paid out while the forward/future has not yet matured. So if you have a forward, you have a fixed maturity. I haven't yet said fixed. So it's fixed. You are getting the stock in a month if I'm long a 1 month future. If tomorrow I say, oh boy, I want it now, which means tomorrow, this future doesn't help me. Right? The future just gives me the ownership on the stock a month from now. Good. Now, if I now computed the price of the forward of the futures, now I can also compute the value of an option. Now, if you see option pricing models, they look like as if the underlying was the stock, but you can rewrite things because they have I was about to say, a deterministic relationship with each other. Yeah? You can think about a forward is the stock price minus present value of dividends within the maturity spectrum. So therefore, the option is, there are two ways to think about. It's either written on the stock, but then you have to penalize, take away these dividends, which are paid throughout maturity, or you just take the underlying to be the futures itself. And this is already ex-dividend. So that you see from the pictures is the more accurate thing to think about. And what volatility, what an option trading is doing, well, it is considering the price for volatility in the underlying. Good. I'll leave it at this high level. Again, it's from this Eurex trading, so they also left it at a high level as of now. So here's an interesting thing, which I think now gets a bit easier if you are new to these derivatives. Let's think about what are underlyings in the spot market and how does this relate to traditional asset classes you might have come across. So the first thing to think about is we have the money market. In German it's called Geldmarkt. That is basically short-term parking of money, and you get an interest rate for that, like you park money for a day, for one night. You get an overnight interest rate, right? It would be annualized, but you get it paid out for 1 day. So it's not much money, but it's better than parking it under the pillow. And you can also park it for a month, let's say. So therefore, if you are interested in getting quotes of traded interest rates on short maturities, you can look at the money market. What is the interest rate there? But keep in mind, it's not the interest rate that you have to pay or that you get, but it's for big institutions, who have ideally deep pockets. But it's a good indication, basically, what short-term interest rates look like. Now, then you have another spot market, would be the bond market. In German, it's called Rente. I don't know, Rente. I don't know where this name comes from, but Rente, it's not a unique defined term, let's say it this way. Yeah. What is Rente in English? Which one? Yeah, maybe so something like that. Retirement money. I think there must be a more catchy term for it. Okay, so bond market, also called Rente. What you do there is you are trading future important known cash flows. Yeah. So that's what I said before. The Rente, the bond, is nothing else than dividend discount model, but the dividends are now fixed. It's the 5% bond, so you get a 5% coupon. 5% on the notional, which is 100. So you get $5 every year, and now you're pricing it using dividend discount model. Good, and that is usually done for government bonds and for corporate bonds. Good. Now the language is a bit different. Then you would trade yields. Sometimes I say interest rates and yields at the same time, but if you have a maturity in your argument, like here, between money market and bond market, you see that the trader calls these short-term interest rates just interest rates. And the longer term, which are derived from the bonds, they call that yields. Okay. Okay, now you see here's a nice business type chart. So you have here the money market, Geldmarkt. Yeah? This is one type of spot market where you basically get information / allows you to trade your views on short-term interest rates. Then you have another spot market, it's the bond market, or called fixed income. There you can get information / trade on longer-term interest rates, which are called yields. So that's a good term, yeah? And that you can do for governments. So therefore, if you buy it, say, for Germany, the discount rate here will depend on the German economy, German inflation. If you buy it for Greece, think about 2008 financial crisis, Greece going bankrupt or not, this discount rate for Greek bond would also contain, of course, the default risk for Greece, yeah? But not the equity risk, because the coupon is fixed, but Greece might not pay that fixed coupon. So therefore, the discount rate has to compensate for that risk. Yeah, so I think by now, if you follow the material and you think about it again, you see that we can use these concepts and apply that to asset classes we haven't talked about. You just then think about what are the risks here, and are these risks potentially systematic? So could I diversify them? If I could diversify, the premium should be low. And you see the Greek bonds, they didn't have much of a credit risk priced in prior to 2008. No, 2012, sorry. I talk about 2012, the Euro crisis. Okay, then we have real estate, Sachwerte, yeah, so real assets. We had a case study on that. So this could be real estate, there are ways to invest into infrastructure like bridges or a new Atomkraftwerk, these type of things. You can purchase Rohstoffe, commodities, gold, Schweinebauch, whatever you want. Then there's another asset class, another spot market for, here it's called Aktienmarktrisiko. I kind of like that. It kind of talks about diversified Aktien portfolios. So think about the DAX, S&P 500, the FTSE, so all these indices, but also kind of think in terms of the ETFs, because ETFs are kind of diversified, even if it's naive diversification on some, but it's diversified. So therefore, if you invest in these spot instruments, you're basically investing in the market risk premium, like the DAX, it's the German risk premium. S&P 500 is the American risk premium. Why should they be different? Again, the thinking comes in. Cap M. Risk premium could be different because maybe the risk aversion is different of the investor who buys American versus German equity. That was maybe an argument in the 1990s when markets were more segmented, right? But nowadays trading is very international in these countries which are so similar to each other. So I don't think it's this risk aversion which might differ, but it could be variance is different. Yeah? Usually it's highly correlated, but could be different. If Trump is, now we are not paying so much attention to that anymore, but keep in mind when the president came first, big news, this affects the variance, maybe in one of these countries first, kind of. Yeah? If there's this Zoll attacking Germany, then most likely the German risk would be higher in that moment than in America. According to the CAPM, we should also anticipate that the risk premium in Germany is higher. So valuations drop. Because if the price drops, it's because one reason could be the risk premium is rising, as I just gave in my example. And then there's another asset class in that chart here, and this is called business risk. So that's kind of when you invest into single stocks. Yeah? So you really want exposure to the epsilon here. Yeah? You want exposure to the epsilon of individual business models. So that could be, as it said, börsennotierte Aktien, yeah, so just single stocks. It could be private equity, so it's like stocks which don't trade on the exchange. Think about Bosch, for example. Or think about partnerships in hedge funds, medical doctors, law, and in all these professions. Usually they also have AGs, Aktiengesellschaften, but you cannot buy them on the exchange. So there's an interesting thing here which I noted is that most equity is traded over the counter / is private. Not sure you know that. first time I heard it, I also was like, oh shoot, that's interesting. Because it's a big world which we can never enter. Right? Because in exchange, I can say, I want that stock, I get this stock. I just pay for it. Right? But if equity is private, I first have to know, then I need to make a contact somehow, and it's hard. Demand equals supply, it's intransparent, so I just don't really know how big is supply there. Or supply I kind of know, but how big is demand? So it's more difficult to know I paid a good price or not. These thinkings, which I just resembled, is really what's going on between trading over the counter versus on the exchange. Okay, and then we have venture capital. So venture capital, even kind of, as the name says, a venture, like an adventure. So it's like an early stage firm who needs some equity. And for that, you have a price, you're buying it because you think the epsilon of that venture will become positive over time. Okay, and then you have currencies underlying here, yeah, which kind of says you have all of the mentioned asset classes, usually for different currencies. So in that sense, you can really get a lot of information. Again, financial data science, tradable data. This is the minimum amount of tradable data we have. There are things which are not plotted here, but you can make them to be special cases of what's given here. And this is quite a bit. And the good thing is they all have a price. Because they have a price, we can identify with a bit of modeling what are expected dividends priced in, what's the discount rate priced in. That is then really what sophisticated investors are doing. We can't do that in this course because we have to stop somewhere, but I want to give this intuition already that you can put things together later if you wanted to with our help, for sure. Okay, so I have to check the time. We still have 6 minutes to go. So now we just talk about some of these markets. Yeah. Now the money market. So money market are usually interest rates up to 12 months, and the pricing is determined exactly like here. Yeah? So the demand supply matches in every point in time. So if for some reason you have a push, so kind of there's new information, the demand curve shifts, then demand supply doesn't match anymore, you see the price is going to adjust so that it matches. Good. Here's the example. It could be there's a bank and just midday it realizes it needs 100 million of additional dollars by end of day, and the way they would get the money is by the interbank market. Good. For the money market account, let's think about the first two columns, and then the third column are derivatives on column 1 and 2. So there are different names, different specifications. I don't go into detail. If you care for that and you have difficulties doing your research, let me know. I can help. So there's like Zentralbankgeldguthaben, so every bank has to hold a specific amount of money with the central bank as collateral. Then there's Tagesgeld, which we might know, Festgeld, which also the banks offer to us. Repo-Geschäfte, Wertpapierleihe, that's about I need money. It's like I have an expensive watch. I give the watch to someone. I say, I get the watch back tomorrow, but today you give me 50% of the value of it. And if I don't give the money back tomorrow, you can keep the watch. And this is like a Repo-Geschäft. Wertpapierleihe, I just give a stock, some asset instead of my Rolex here, which I have two of, left and right. Then the second column, verbriefte Geldmarktinstrumente. So it's like if you have the government giving out the bond, you have like in the US the treasury bills. So this is maturity up to 12 months. It's not the bond. Bond has longer maturity, so it's a bill. In Germany it's called Bobbles or Bubbles. It's going to come. In Swiss, it's the Geldmarktbuchforderung. Also, you have banks themselves, like Deutsche Bank, Commerzbank. They also give out these Einlagenzertifikate, the certificate of deposit. You could check, I've never done, whether the interest rate is different than the Festgeld, should be higher. And if you have companies which are big and famous and have a good balance sheet, they also offer or ask for short-term funding, which is then called commercial papers. Yeah, and you have an interest rate on that. So if you wanted to work with that, this is where you could get quotes. And then you have derivatives on these money market instruments. So there's like a forward rate agreement, overnight index swap, Geldmarkt futures, and the like. but here I don't have any examples for that. Here's a screenshot which I jump over to save some money. Time is money, so I want to save some time, which is like saving money. You can go back once we went through everything, but okay. Since I see sad faces. So here's a screenshot from a Bloomberg, and you can just you get a snapshot, end of day usually here, what was February 23rd, 2019, what were the rates for different instruments in the money market. And then some of them I have in my explanation slides here. But I try to save some time. It's the wrong direction here. So here's the summary slide, money market in the US now. So we have the Fed funds rate. That is the rate at which the banks lend and borrow central bank deposits. So it's because the banks have to keep some money with the bank, with central bank, and they get deposit. They get interest rate for that. So if I have 10% too much in it, I could give it to some other bank who might have too little. Yeah? And there we would borrow at, for example, this Fed funds rate plus maybe a little spread for the credit risk of the counterparty. So therefore the Fed funds rate is controlled by the central bank. So usually when you hear these central bank statements, we leave interest rates unchanged, it's the Fed funds rate they talk about. Yeah? So if the Fed funds rate goes up, it means that the banks are getting higher interest rates if they park the money, and they are more happy. Yeah? So therefore they are doing less with the money in the free system, and that is how the government, the central bank tries to control indirectly money flow in the system. Although in the US they don't care about money flow, the research changed in the early 2000s, it's all about the interest rate basically. But in Germany, in the older books we tend to think, and even the ECB now still talks about interest rates and money supply in the system. Yeah, but you try to attack money supply here, controlling the Fed funds rate. So the Fed funds rate is something you can think about being here the risk-free rate, some short-term interest rate, for example. Okay. Now usually what a central bank is doing, it sets a corridor. It says the Fed funds rate should be within maybe it's a 10 basis points, 20 basis point corridor around the target. Yeah? And then they have traders in the central bank, in the New York central bank, for example, and they ensure that the Fed funds rate at which the banks lend themselves the central bank deposits excess what they have to each other, that it stays in the corridor. So that's an interesting field in itself. How they do that, the way they do it in a nutshell is by offering bonds to the banks, government bonds, kind of providing opportunities for their investments. Then we had commercial paper, it's for high credit corporations. Okay, I finished the slide and then we have a break. There's interesting thought. If you put up collateral, the issuer is unimportant, right? If I give the Rolex, which is valued, let's say 10,000 for something which is worth 1,000, it doesn't matter, it's me who wants the 1,000, right? Because the Rolex is 10,000 worth. If you sell it in the market, maybe you get 5,000 for that. So therefore you kind of see why collateral is important in real life and therefore also in finance, because it allows us to abstract from whom are we trading with. Just about how secure, how much collateral do we have, how much security do we have, that if the person doesn't pay, that we get our money. Okay, in our commercial bank, commercial market, CP, is a dealer's market. That's also a jargon term. So dealer's market means you have a few investment banks, they are the dealers, they are buying a large chunk of the data, of the commercial papers, and then they go to their own customers and try to sell it on a profit. So for the company it's good because the company doesn't have to approach. So they just have this intermediary in the middle, and the intermediary tries to make some money because they get a spread, yeah, depending on the demand for that commercial paper and the current price. Good. Then you have treasuries. So there you have that for treasury bills, the banks, like investment banks, they are buying the government debt during auctions when the treasuries get auctioned, and then again they sell it to their clients. So that's, and what you then usually do is you are in the secondary market and then you buy it from someone else. Yeah, but here it's about kind of when it gets created. Okay, so therefore from that point, the money market relies on intermediaries, something we ignore here. But interesting, I make a loop. There's an asset pricing, advanced asset pricing class at KIT as well. There are asset pricing theories which go beyond what we have in the dividend growth model, and they try to model the intermediary explicitly. That has been something over the last 7-8 years in research, has been getting more famous. And I think I also ignored that because in my studies, we never went what I just teach you now with all this data we have. We worked with these theories, blah, apply it. So I just want to make this connection here. This is really relevant. You see, money market is a big market. It's important for the risk-free rate, and it's a dealer's market. Yeah? So you really see it matters how risk-averse are the dealers. Yeah? How much variation does the dealer portfolio have? So I still work with the CAPM, but it's now a thinking frame which I now apply to something else here, to the dealers. And this is kind of what this intermediary asset pricing has shown. It can explain price movements better if you consider the balance sheet risks of the dealer instead of the aggregate investor. So that is not something we need in the course, but I just wanted to make this link. And I think go into the break highlighting that having an overview of this tradable data is kind of useful. Okay, thanks guys. I see you after the break.